Thank you very much. Good evening, everyone. And it's such an honor and a fantastic setup today. We are connecting live online, and it's an amazing feeling. The way that you guys have actually brought in everything. But certainly, I think it's a very exciting topic. I'm going to quickly start the presentation. And, basically, today we're actually going to talk about. The investment management, behind the scenes, actually, of what do portfolio managers do actually for a living, and many times, you've seen that investment management is something that is, something of a serious business, right? Uh, but many times, we as investors do not give the requisite, focus when it comes to investing, and typically, a lot of times, we ask questions like this is the first question that everyone asks: Markets kya lagta hai? Bazaar su lage che in Gujarati, if I will, right? And should I buy now? Should I wait for a correction? Markets valuations are very high. So these are a lot of these typical things that you hear from an investor. Should I wait for a correction, perhaps? Um, in a down market, again, markets falling. I would rather wait for some stability before entering, right? I mean, nothing wrong with that. I don't want to catch a falling knife. Everyone is concerned about so many things. And there are people who also say that I would rather buy on an up move, by paying a little bit of premium, etc., etc. And there are variables also people look at, right? Economics, political uncertainty, global events. Uh, Also, earnings growth of Nifty is very low. So these are some of the things. These are some of the conversations that we typically tend to, hear when it comes to investing. But at the end of the day, the real question is all these things, the point is, does it really matter? So let's go really have a look at how the markets have behaved in the last 10 years, right? This will tell us that all what we have spoken about perhaps may not be that valuable, right? Here is a chart which actually shows the Nifty returns right from calendar 2011 all the way to current year to date, right? And the second column is actually the Nifty returns. If you actually see year by year, these are yearly returns, right? Point to point returns. So, for example, in 2011, if you see, the Nifty gave a negative return of 24%. But the top five performing companies like Lever, Eicher, ITC, Britannia, Ultratech did extremely well. And there are other companies also which did much better than the 24% minus return. Similarly, I mean, the entire list actually talks about some of these really companies which have been really consistent across the board, right? If you look at the last year, I mean, the current year, for example, for everyone, Nifty YTD is down 8%, but you are seeing companies like Dr. Reddy, Cipla, 57%, 50%, Reliance up 40% close to, and the list goes on. So honestly, I mean, does that the questions that we keep asking and what actually the reality is, the question is really, does it matter at all? So the real actual question is, what matters, right? We need to address that first, right? Before we do that, I think we need to also understand what do these companies have in common that make them so consistent across time periods, right? Um, you know, some of the common characteristics that we as fund managers have noticed over a long period of time for some of these companies to really deliver in a consistent manner is that these are companies which have actually focused on their own strength. They have not gone and borrowed some idea from somewhere and then came up with a business model. They've been working on it for years and years and years and have gotten better at it. They have grown their businesses irrespective of market conditions. Yes, they do have a negative patch or a slowdown, because everything is dependent on cycles. They also do get impacted by cycles, but they come out even stronger post that down cycle. And the reason for that is they have a very solid business model. When I say business model, it's really the costing, the niche areas, the competitive landscape, etc., etc. Similarly, most of them, I'd say most of them, not all of them, would have invested their own capital for most points in time. So you would rarely find them coming to the capital markets and raising money. I'm not talking about banks, because banks necessarily have to raise capital once every 3 years, depending on the growth. But by and large, most of these companies would, typically reinvest their own capital and grow the business. And then, consistent in terms of margins and all of that. Similarly, excellent and robust balance sheet. So, typically you'll find them to have very low leverage, etc. And return ratios, again, a very important component that you will across the board find a lot of these businesses which have really performed over a very long period of time will have very consistent and strong return ratios. By return ratios, I mean the return on equity, return on capital, whatever the metrics may be. Right. So, so ultimately, after all this, now we have realized that, asking those questions like market kya lagta hai, and, where do we go from here? Are we seeing a correction and all that? Those are things, let's park that aside. But really speaking, what are the key variables that we need to keep in mind as an investor in the market? Okay. Let us understand that we are actually not investing in the market, but eventually we are actually buying businesses, right? Effectively, when you're constructing a portfolio or, you're buying something from the stock market, it is actually you're buying businesses. You're becoming a part owner of that business. Maybe even with one share, you're doing that. Hence, there are three important things that you need to really look at when you're actually trying to buy businesses. The first and foremost is to understand the key variables of that business. What are the key drivers of that business, right? This, once you understand this, it more often than not leads to better return outcomes. Second, stock markets are slave to earnings. That I don't think anybody can argue with that. Primarily because stock prices are actually dependent on, the quantum of earnings growth and the quality of earnings growth. So anytime a company has a consistent growth trajectory, I think stock markets generally tend to reward such companies. And finally, when we talk about PE multiples, what are we actually trying to do? PE multiples generally tend to expand only in companies with higher growth and better return ratios. So you might have seen yourself, there are certain companies which are trading at 40 times, 50 times, even 60 times, right? And there are companies which are struggling at 10 times and 15 times. So there is a particular reason. There is a method in the madness in terms of why markets actually become partial when it comes to some of these companies that are delivering, and they are very generous in terms of ascribing a P multiple, right? So, with that, I would like to just, introduce, what happens in the mind of a fund manager or a research analyst, when it comes to identifying the right businesses, looking at the right stocks. What are the basic criteria that any portfolio manager, for that matter, would look at? Some broad kind of guidelines, right? So broadly, equity research, obviously, as everyone knows, is based on business fundamentals, because ultimately it's the fundamentals that determine their PE multiples and all of that, right? So there are 6 areas broadly. I mean, there could be many, but for simplicity reasons, I'm going to just talk about 6 broad areas where investors can typically look at. Fund managers can typically on a day-to-day basis generally look at some of these characteristics, like robust business dynamics. What does this mean? Does the business that I'm in have the scale and size and the opportunity to grow, right? uh, 50%, or thereabouts, your decision is generally becomes a lot easier once you have an answer to that. That is there a scale and an opportunity to grow, right? If you can determine that for the next 5-10 years, I think life becomes a lot more easier. And of course, the sustainability and longevity of that competitive edge, if at all that business has got a competitive edge, right? So, I would urge that, people should spend a lot of time analyzing this particular matrix, because it's very important to understand, um, this when you're looking at businesses. The second area is the sustainability of profits, because ultimately, we are buying businesses because they are profitable, and then they are expected to grow their profits over a period of time. And quite clearly, markets ascribe a premium only to companies with quality and sustainability of profits. It's as simple as that. So the bulk of the time basically goes in figuring some of these broad things out, and the quality of growth. Where is that growth coming from? Is it, does it have the quality, or is it, through reckless diversification, etc., etc., that you get a temporary growth and then kind of it falls off. But like I mentioned, the metrics of ROE and ROC are extremely important when it comes to analyzing all of this, um, because these are two simple ratios that you can look at. And almost always, when you look at high ROE, ROC companies, you'll always see them trading at a higher P multiple. Um, Efficient capital allocation. Again, this is something that is so important, especially in a country like India, where there are multiple businesses in various sectors, etc. Efficiency of capital means, are the promoters really focused on the business that they're doing, or are they diversifying to other businesses because they see a short-term opportunity or something like that? They're not consistent with their capital allocation. How focused they are on their own business. So it's a very, very important decision parameter. Typically a lot of research analysts and fund managers would typically look at all of these things very, very closely. And finally, last but not the least, is the valuation. The reason I put valuations at the end is because I think, the first four are extremely important. Once you get that, then, valuations become a lot more easier once you have a handle on the other four. Things like P, price to book, how much earnings it is discounting, etc., etc. Right. So, once you understand the business, then we move into portfolio construction, right? I mean, what drives when we have to buy or construct a typical portfolio, for example, right? Some of the key things are extremely important, right? We need to focus on some of these areas. Is the portfolio aligned to the investment objective and strategy of the fund, basically the mandate, if you will? The second area is the regulatory limits and all the other internal limits. Basically, what this does is puts you in terms of a discipline, in terms of following certain rules and regulations when you're constructing a typical portfolio. And of course, the risk matrix, liquidity, concentration risk, etc., etc. Right. So when you're typically constructing a portfolio, what really goes in most of us, when we think of a particular portfolio, is stability and so the portfolio should effectively give you a stable and consistent return over a long period of time. For that, you need a mix of stable, consistent companies and a few alpha generators, right? So typically, let's call them compounders. These are kind of companies which have a very unique business model. When I say unique, hard to replicate, and then they have demonstrated their ability to generate consistent return over a long period of time. So bulk of your portfolio essentially, should consist of these kind of companies. Otherwise, you will be awake all night. If you try and put a lot of risky bets, then you will be watching the Dow Jones in the night. Then you will wake up and watch Singapore markets, and then you'll watch Indian markets, and then you will watch European markets. So you'll be busy around the clock. I don't think that's the intention when you're creating a particular portfolio, right? So hence you want stability in your portfolio, and some of these compounders actually tend to give you that. The second, this is where the alpha generators come into the other part of the portfolio, where you're identifying theme-based or turnaround companies involved in businesses that are coming off the cliff, where you see potential of substantial growth. These are risky bets, no doubt, but these are the ones that give you that extra returns to the portfolio. So, as it says, compounding machines actually give you stability of the portfolio, while alpha generators actually provide you the risk return kicker in the portfolio. Right. So let me talk about, quickly in terms of what are the things that portfolio managers do, and some of the things that a lot of people don't pay too much attention to. When you look at a portfolio, it has got 50, 60 names, right? There are a lot of companies which are doing well. There are some companies which are not doing too well. A lot of times, the attention is not on the drawdowns or the weaker companies, and most portfolio managers would typically focus on their winners, right? Because that's where the maximum money is, and ignore the drags in the portfolio. So typically what happens is, whatever returns that you make on the other part, which is doing well, the draggers typically take away a substantial amount of return without you even realizing. So I think this is an important part when you're managing a portfolio, that you give equal emphasis on all the parts of the portfolio, so that if you find something which is clearly not working, or perhaps there is a mistake in terms of that you've bought that particular company, or whatever, something didn't work out the way you had anticipated, I think it's better to take a decision and either get out, or do more analysis. Unfortunately, not too much attention is given on this particular part. So I think I would stress all of you, maybe who are looking at portfolios and things like that, to kind of have a very clear focus on this part. As they say, hope is not a strategy, right? So in summary, what I would again like to kind of talk about is, I think overall, as I spoke about earlier, I think it is businesses that we are buying, whether it is you, me, or anyone. I think the focus should be, you should spend a bulk of your time actually looking at businesses, focusing on businesses, and less on markets. I don't say that you should ignore markets completely, but I think bulk of your time, I think the idea is to look at the businesses that you are invested in, look at the winners, look at the drags in terms of your portfolio. Markets will go up and down. Markets will do lots of things based on events, etc. The second important point is, let's not forget that it is actually the businesses that create wealth for the investors over a long period of time. Markets is a collection of all these businesses put together. Some are good, some are bad. So it's like it's not going to give a very good indication in terms of the direction, right? So there's always will be an element of confusion when you're following markets and basing your investment strategy around how markets are going to do. And finally, I think a robust investment process is the key to kind of get a very consistent and performance outcome across all any portfolio that you're kind of managing. So I think in conclusion, I'd like to say that I think markets, looking at markets, observing markets are very, very important. But let us not base our investment strategy on markets alone, because that's going to make us very, very indecisive in what we are trying to do. So with that, I'd like to close this session. I really thank you for this opportunity and invite you for questions.
Hi, Ravi. That was a very lucid presentation. Thank you for sharing with us. There's a couple of people asking they like the presentation, so they've asked for a copy of the presentation. Is that fine if we share it with them later?
Yes.
Okay, so we'll do that. And we really don't have any time for questions now. So, and there aren't any sensible questions which are left. So, let's move on to the next session. Kavya, thank you
So
so much,
Prem,
Ravi,
can
for
I
being here.
can I can I conclude? Give a concluding remark, which
Please,
probably,
okay, please
uh,
do.
yeah. So when you're observing market, it suddenly occurred to me that this song, this Hindi film song, मैं जिंदगी का साथ निभाता चला गया, हर फिक्र को धुएं में उड़ाता चला गया. If you superimpose that on the markets,
Hmm.
effectively markets driven by all these events, right? We move
Correct.
from one event to the other, one event to the other, and most of our time and energy is wasted in terms of looking at these events,
Done.
right? So I think we should realize that all these events have gone and the markets is at all-time highs, right?
Correct.
Great. That's all from my side. Thank you so
Great,
much.
great, great. Thank you for that brilliant insight. Really, over a period of time, these markets move on, and what looks very important and scary to us is something which markets take in their stride over a period of time. Thank you so much, Ravi.
Thanks.
Okay.
Thanks. Bye.